So I actually want to start where we left off with Ryan. It's really interesting that you think about what really worked in 2025. It was the so-called boring parts of the AI trade. A lot of these, memory disk makers, memory chip makers, that is, in the likes of Micron. I wonder, whether you expect that will be the momentum headed into 2026.
Well, it's pretty much explainable why these memory chips, boring pockets of the market, gain more than the other exciting parts. And one of the reasons for that is that because the AI chip demand was so strong, that many manufacturers actually assess more capacity in producing these chips in demand, and they reduce their capacity for producing other and more boring pockets of the market. And that's one of the reasons why what explains actually the rally that we've seen in Sanix and Seagate and Western Digital and like. Into 2026, we think that not only that the most boring and undervalued pockets of the market will be in investors' radar, but we will also expect to see actually this technology and AI rally broaden toward the non-technology pockets of the market, because the AI productivity, AI cost efficiencies would also benefit to any other sector out there, including banks, healthcare, industries. And I think that this is going to be the big story of 2026.
Yeah, absolutely. And we don't have much longer to wait. I want to talk a little bit about, what didn't necessarily work when it comes to the overall AI trade in 2025. And it's tempting to talk about that as a monolith. But while memory chip makers seem to have a great year, you take a look at some of these software names. Adobe comes to mind, for example. And it feels like some of these companies just can't get their footing under them. ServiceNow, Salesforce, also examples there. I wonder, what you make of what's going on in that sector.
Well, these companies have come under the pressure of AI. You would expect that making AI tools available to investors would boost their revenue, but it actually had the exact opposite effect on these companies. They have not been able to monetize and sell these AI-boosted models to investors as much as they wanted. And actually, the fact that other AI models came to the market to challenge these companies have also been a big problem for these companies. We think that in terms of AI applications, the competition is going to be quite rough in 2026, because there are a lot of AI models. Some of them are going to be winners, some of them are going to be losers, but it's exactly the same story for the big AI applications and the likes of AI, Adobe, for example, or Shutterstock. All of these companies that just integrated AI applications on their product offering will have to face that competition. I think that that's going to be also waiting on the margins.
Yeah, it's a good reminder that there are companies that are doing the disrupting, and then there's companies that the market thinks are being disrupted right now. But I also want to talk a little bit about, what we're seeing when it comes to Capex. That has remained one of the dominant stories when it comes to, every 3 months we get those earnings report. And we've seen it start to really get expressed in certain companies. Oracle comes to mind, both their equity and their debt. This pressure to see some sort of ROI when it comes to spending. I wonder if you see that pressure broadening out next year, Ipek.
Of course. I mean, since the last 3 months, since the last earnings season, what we have seen is that the shiny headline figures were no longer impressive for investors. They wanted to dig deeper into these reports. One, how are the revenues are being accounted, and two, what's happening with the debt? Is the debt too high, or is the debt being offloaded? Was also one of the questions that investors have been asking and have been worried about. So what investors want today is to see slowing investment until we see return on investment. The problem here with the technology is that if there isn't overspending, the risk is that this technology gets outdated by the time revenues start coming in. So we really think that spending is going to be one of the major issues and major talking points into 2026. And one way to go around this risk is to choose companies that are able to turn this overspending into an immediate revenue opportunity, like the ones that do have data centers, the ones that are actually able to rent their chips out. And in this context, what we see is Microsoft, Amazon, and Google are the three companies that could help investors reduce this risk of overspending in AI.
And Ipek, I have less than a minute with you, but before I let you go, I would love to hear, heading into 2026, what is your highest conviction?
Well, the highest conviction right now is rotation, again, from technology to non-technology pockets of the market. I think it is important to note that the macroeconomic backdrop remains positive for technology stocks as well. So we think that the rally could continue, but it might decelerate next year. And again, the AI enthusiasm will probably move toward the non-technology pockets of the market, toward the sectors that actually do also use technology that could be boosted by AI tools.